Good morning, guys. Welcome to your Investing Masterclass October 2025. My name is Ronke Odewumi, and I'm super delighted to have you in class today. Bit of an introduction before we go on into the class, because quite a number of you have registered for this class via Instagram, and some of you have registered to other platforms. So I should tell you a little bit about myself. I'm a chartered accountant, and I have worked in management consulting and strategy for the last 21 years across Big Four. So that's Deloitte, KPMG, EY, and so on. I'm your personal finance coach, and I'm here to break down personal finance, specifically investing, in a format that you can understand and make actionable decisions. I'm a mom, I'm a sister, I'm a wife, I'm a friend, I'm a Christian, I'm married, and I have 2 young girls. After this class, you can connect with me via my website, you can connect with me via email, you can also connect with me via Instagram or TikTok, where I have identities that are exactly my name. The same also applies to YouTube. With Facebook, I have Ronke Odewumi page as well. I'm reachable through all of these platforms if you have questions or if you want to talk to me. Today's course is going to take us about 2 hours, give or take here and there. You need to be in a quiet room where you can access or listen to this class to make sure that you can take in what I'm going to be teaching today. I like cameras to be on because it's quite an interactive class. I am recording this class so that you can listen to it on demand as frequently as you need to. And as I said before, after this email or after this course, you can reach out to me via email or via my Instagram DM. Now, the objectives of the class today, the reason why you're in class today, and what we are going to achieve is to introduce you to key investing concepts, get you started on your investing journey, take you from, I don't know what I'm doing, I don't know where to start, to, I know what I'm doing, I know exactly what I want and how I'm going to go about it, what I'm going to buy, how I'm going to continue my investing journey, what I'm going to be thinking about when I do my investing, the different kinds of investing instruments available to me, which one I'm going to buy, and the informed decisions I'm going to continuously make about my portfolio. See, this class is an introduction to investing, is an educational class, is designed to get you started on this important journey. I would like to point out that it's not a budgeting and saving class. It's not a debt reduction conversation. It's not an opportunity to talk about paying off your debt and how you can do that. It's strictly educational. It's not financial advice and should not be treated as such. The financial market is quite volatile. In fact, yesterday night, Friday, the market in the US stock exchange dropped. S&P 500 dropped by 2.67% just by Friday evening when the market closed. So it's a volatile market, and investments may grow or fall below their purchase value, and you should always do your research before you do any form of investing. You should ask questions. You should aim to understand what you're doing before you do it. Now, this course is for anyone who is interested in managing their money confidently, who wants to know better, who wants to build their knowledge of investing, who wants to buy and hold investments, improve their financial knowledge, and kind of protect themselves from fraud or from being swindled by people who have all sorts of investing ideas. You don't need any prior qualification to be in this class. I have delivered this class to 17-year-olds. I've delivered this class to much older people. I've delivered this class to people who didn't go to university and people who didn't have who haven't done mathematics in years. And trust me, you will understand this class. I will make it as simple as possible, and you will be able to take action after this class. It is, however, very important that you take action as soon as possible after this class so that you can utilize the knowledge that you have gained. Because if you pack the knowledge and go away and say, now I've done the class, I've ticked that box, I will come back to it later. What you're going to do is you're going to shortchange yourself, because when you come back to it later, you're going to be confused. I'm going to be like, I thought I understood everything, but now I forgot it. That's because you left it for too long. Now, before I go on, I have a question for you guys. What is investing? Somebody taps you on the shoulder today, and say, I need you guys to interact with me. Well, what is investing?
Making your money work for you.
Okay, making your money work for you. Any other ideas?
Putting money away to get compound interest.
Putting money away to get compound interest. Okay. What do you mean compound interest?
To just get more and more, just see the portfolio grow.
Okay, growth.
One thing a
Okay,
day.
okay. Anybody else? Okay, so you guys are on track. Both answers are correct. Investing is making your money work for you, and it's growing your money. So those are the two answers that I always get in my class. You know, growing your money, making it work. And there's one other bit that nobody talks about, and is entrepreneurial ownership. Now, when you put money into an asset, when you invest, that money needs to grow. That is one criteria I want you to use every time you hear if somebody says something is an investment. You know, when summer comes and we go for barbecues and they start telling you that pot in my kitchen is an investment. I invested. Ask them, when you sell that pot, will you get more money than when you bought it? If it's not going to grow, it's not an investment. Investing is like planting seeds with the hope that they will grow into bigger plants over time. That is why some of us are investments for our parents. A child is an investment. A pot is not an investment. Because when you give a child an education, if you pay £5,000 for that child to go to a particular school, you're not expecting the child to complete the education and just earn £5,000 and sit down. No, you expect that child to now keep working and keep churning. That is why human beings are investments for the government. The government invests in our children by giving them free healthcare because the government expects them to grow up and do what? Pay tax. So an investment is meant to grow your money. It's like a plant. You plant it, you expect to see results. Now, secondly, it's making your money work for you. If you have to put your finger there and hold the hand of your money and be there, that's not an investment. When you are sent to school and you grow up, your parents don't start following you to work every day since they paid for your education and start following you to work every day to make sure that you're making it. No, they let you get on with it. Because now you're an investment that's going to yield results, even if the result is just bragging rights. That's what they asked for. So making money work is you have to be in your bed and your money is working. So you put your investment somewhere and it's working for you. So when you buy a Rolex wristwatch and you tell yourself your Rolex wristwatch is an investment, is the money growing? When you are not wearing the wristwatch, is the value increasing just because it's sitting there? No. Entrepreneurial ownership is another thing that investment does. A lot of people don't know about. When you buy part of a company, the reason why a lot of us don't know about it or don't think of it like that is because we think of investing as an outside entity, something we do with strangers. But imagine that I'm running a small shop and I come to you and I say, Inter, give me £10,000 and every month I will, when I get my profit, I will give you something permanently. You're a part owner of that business. You are now a part owner. You are now a co-owner. You might be a silent co-owner, but you are a co-owner. Because now you are invested in that business. You need that business to succeed because the only way you will get profit is if I do well in that business. It's not a loan. It's not a loan. It's not money that you're ever going to get back. I'm not going to say, oh, the business didn't work. The business has crashed. But I will first give Inter our money back. No. If a business declares bankruptcy, the first people they pay back is creditors. That means people who gave the business a loan, not people who invested in the business. So when you invest in a business, you are saying, I believe in this business enough that I want it to succeed and I'm putting my money behind it. So you become an entrepreneurial owner. There was a guy that went on LinkedIn and he put on LinkedIn as his career, co-founder, Google, co-owner, Microsoft, co-owner, Amazon, and he was putting years and putting from years to today. And LinkedIn, went into an uproar because everybody was saying, well, how can he be writing that he's co-owner of these big companies and he's on LinkedIn? Who is he? Who is he? Overnight, he had a lot of followers and everything. Before the people started checking him and saying, no, he hasn't worked at those places. He didn't say he has worked there. He said he's a co-owner because he owns stocks of those companies. It actually makes him a co-owner. He has not lied. So entrepreneurial ownership is buying part of a business that gives you a part of that business. And when the business increases in value, your money increases in value. When the business does well and turns a profit, you get a share of that profit. Somebody needs coffee and drink coffee. Because this journey is a long one. We are here together for a while. Why should you invest? There are 4 main reasons why you should invest. And I'm sharing these reasons with you so that in future, when you feel tired or you lose interest or you feel like, I don't have money this one, Jerry, you will remember these reasons. You should invest because you want to beat inflation. I was at the Bank of England a few weeks ago to talk about interest rates. Interest rates in the UK are influenced by inflation. If inflation goes up, the Bank of England will increase the interest rates to match it so that it can come down. If inflation goes down, the Bank of England will also drop in interest rates to encourage spending. Now, inflation is simply your money losing value over time. It's your money not buying what it can buy in a few years' time. If you go into a property rental shop today with £5,000, maybe 20 years ago, and you tell them, oh, I want to buy a small flat in Kent. Oh, they will show you houses. They will show you houses. 20 years ago, they will show you houses. They'll say, you have £5,000, don't worry. We have houses that you can deposit that for. If you show up in Kent or in Essex today with your £5,000 and you say you want to buy a house, they will sit you down quietly and explain to you that you have a bit more work to do. And that's because £5,000 20 years ago is stronger, was stronger, and is stronger than £5,000 today, because that money has lost value due to inflation. So your savings are unlikely to beat inflation. For you to beat inflation, you have to have interest rates on your savings that are higher than the Bank of England's interest rate or inflation rates that they've set. So investing allows your money to potentially beat inflation rate and preserve its purchasing power. Now, remember, if you and I both had £5,000 20 years ago, and 20 years ago, you decided to celebrate your 21st birthday or your 30th birthday because you only live once, and you use the £5,000 to take all of us to the Shard or Dorchester, and we had a night out, the dinner, the dresses, oh, fabulous, we've got pictures, your rep has gone up, everybody knows you pressed our necks, £5,000. But I took my £5,000 and put it into a property and bought a flat 20 years ago. And then today, you want to buy that same property. Even if you had put that £5,000 in a savings account 20 years ago, and you are collecting interest on it, by this time, let's say this year, you want to buy a property, that your £5,000 will probably be £15,000 now. It will have tripled, or maybe £12,000 because you saved hard. But that £12,000, will it buy you that property? Because by now, not only do I have a property that has increased in value, I probably owe less on the property. You won't be able to buy it because now I have more parts of the property owned over time. So inflation is a key reason why you want to invest your money. Income. There are lots of investments that pay dividends, rental properties, bonds. There are lots of passive investments that pay dividend and give you return and give you a passive income that you can live off. My dad retired in his 50s, and I became a dividend child. I grew up in Ibadan, and my dad would give me a note to a stockbroker, and I would go to a stockbroker in a place called Dubai and go and give the stockbroker the note. And then the stockbroker will collect the note, he will read it, he will tell me to wait. A few minutes, he will give me a check, he will call my dad on the phone and say, you're giving me a check. Then my dad will tell him to give me the phone. They'll give me the phone. My dad said, I take the money to the bank, then I will take the taxi again and get into the taxi and take the money to Mokola and go and deposit it at the Wema Bank there. And then when I deposit the money, the bank will receive an instruction before I go there. Then they will withdraw maybe 5,000 or 3,000 for me. Then I will now take a bus and go to uni. I schooled at the University of Ibadan. That's to show you that he was getting income and living his life. He didn't have a day job anymore. He had passive income. It was dividends. So investing will give you an income. If you invest in an enough amount, you might not even need to work because you can then live off the passive income that you're getting from your investing. The third reason is goals. Investing will help you achieve your goals. If you invest for your children, you might be able to then pay for their uni, and your children won't have to take a loan to go to uni because you open investing accounts for them from a young age and you've been putting in that £100 every month. I did a session yesterday with the church, and I was telling them that investing £100 every month for your child for 18 years gives better returns than investing £500 every month for 4 years, or even investing 24,000 in one go and then sitting down and waiting for you to yield returns. Is the reason why lenders have faith in people who do jobs that don't end. A lender will give a loan to a nurse or a doctor faster than they will give a loan to you, a project manager who is contracting. Because they know that you have bulk money. You have bulk money now. Yes, you might earn £1,000 a day, but 6 months later, you might not have a job. They have more faith in somebody who is earning £50 an hour, who's earning £200 a day, which is just a mega amount compared to your £1,000, but who has a job for life. And that's why time is the secret to investing. If you have time, if you give it time, you will build wealth faster than somebody who has a lot of money but doesn't give it time. So achieving your goals is a good reason to invest, because you'll be able to buy a home, you can fund your children's education, you can retire early, you can travel the world because you have invested. The people who bought NVIDIA stocks 10 years ago and if you bought £10,000 of NVIDIA stock 10 years ago, you would have 3 million now, 3.4 million actually. If you bought just £1,000 of it, you will have £340,000 today. So that you'll be thinking about, do I need to pay off my mortgage? Do I need to just relax? And then you say you don't know where this person got their money from. But that's where they got their money. Wealth building. Investing will help you build wealth. If you put money into the right assets, not just can you beat inflation, you can grow your wealth over time. Now, when I say you can grow your wealth over time, how exactly? How did putting 10,000 in NVIDIA 10 years ago become 3.4 million this year? How? How is that even possible? It's because of something called compound interest. Warren Buffett will tell you that compound interest is the eighth wonder of the world. Because if you let's look at this scenario. Compound interest simply means that your investment earns interest. Then the interest on your investment also starts to earn interest. So suddenly you are getting interest from two sources, and that interest will earn interest. And like that, it's like a snowball effect. The money starts to grow. Now, when a snowball first starts to roll down the hill, it's small. Then it rolls and gets bigger, and the bigger gets bigger until it becomes dangerous. And that's exactly how compound interest works. Now, imagine that somebody called Sarah. Sarah decides to invest £150 monthly. She's not doing much. She invests the money, she invests all the returns and interest, and she doesn't want to collect it. She just invests it. And she does it for 15 years because Sarah is working. So she doesn't need that £150. She's just consistent and she does it. Now, after 5 years, Sarah has only invested £9,000 and her portfolio value is just 10,003. So what? She has made 1,351 after 5 years of investing. You want to laugh because you're thinking, so is this 1,003 that she's waiting for? Now, wow, she will be here for a long time. But after 10 years, the difference between our investment and the value of our portfolio has now widened. And she now has £6,000 on top of our investment. Now you are a little bit jealous and you're thinking, okay, £6,000 after 10 years. Okay, that's not bad. She's not done badly for herself. But after 15 years, the difference between our investment and our portfolio is now almost double. So she now has almost £20,000 on top of her investment. And that is now, if she does 20 years, which is just an extra 5 years, she will definitely have double her money. So again, it is time that works with your money to make you a millionaire, which is why somebody like Warren Buffett did not become a billionaire until he was 60. Because by the time he was 40, he had some decent money, but all that money needed to do was to double. Doubling £10 is just £20, but doubling £1,000 is a different ballgame. And that is the way it works. The bigger the money gets, the better compounding works with that money to build your wealth. Now, even with moderate monthly contributions, consistent investing will respond to compounding effect better. So discipline and long-term investing. Invest and look away. Whatever you do, set up a direct debit. Don't think about it. One of the things that has really simplified my life, I'm a big advocate of simplifying your life. Like, I don't make more money. No, that's the food of the devil. I like simple life. I simplify my life to the lowest point, which means most things are on direct debit. I automate as many things as possible. I automate payments, I automate reminders, I automate everything. So as much as possible, even your investing should be automated. That way, it's happening without you putting your emotions into it, without you having to think about it, without you having to say, oh, do I want to do it this month? Do I want to? Can I afford? You can afford it because you can afford to pay your rent. You can afford to eat. Investing is you taking care of your future self. So are you prioritizing other people over yourself? Are you prioritizing other people's payments over yourself? Are you building wealth for other people at the expense of yourself? No. So you are going to do a moderate monthly contribution and you are going to invest moderately. Now, this is the question that most people ask me. This is the reason why people register for this class. How do I start? Okay, you've convinced me, but how do I start? I don't even know where to start. I just keep hearing all these things. I keep seeing all your, I like your videos, but where do I start? Because now you have started a pie. You have started a pie now that everybody is copying your pie. Me too, I want to copy your pie, but where? How? And that is what we are going to do in this class. You can start investing in these 6 simple steps. Very simple steps. I'm going to walk you through these simple steps so that at the end of the day, you know exactly what you need to do. And these simple steps are that we are going to choose an investing platform. I'll show you those platforms. We are going to open a tax-efficient account. There are different kinds of platforms. I will tell you what each type of platform does and what makes them different from each other. Then the different kinds of accounts you can open. Then we will look at the different kinds of assets you can buy, different kind of instruments you can buy once you have registered on a platform and opened the right account, and then you can decide the kind of assets. We can then talk about my pie and what's inside the pie, and then you can choose your investments, you can place your order, you can rinse and repeat. Now, if you are not on your phone, if you are using the computer, it's okay for you to actually start opening the account as we are talking. If you don't already have one, it's okay for you to kickstart the process. Don't wait till you're outside the lecture to come and say, oh, I got stuck. I didn't understand. No, start it now. And if you've chosen a platform, once we talk about investing platforms, if you know the platform you want, go ahead and open an account. If you already have the platform open, go ahead and open the tax-efficient account. If you already have the tax-efficient account open, once you understand the assets, start looking at it. Because right now the markets are closed. So any decision you make is pending till Monday. You can cancel it after the class. You can take your time. There's no market that's going to sell you anything over the weekend, which is fantastic. Because sometimes I leave buying instructions on a Saturday. I set it up like I'm buying it. I buy everything. Then I think about it. By Sunday night, I will have canceled 3 of them. Actually, I don't want to buy that thing. I don't want to buy that thing. I don't want to buy that. I want to buy that. So that by Monday, the order is fulfilled automatically for me. That's how I run my own shop. So anyway, there are 6 key steps that you follow when you want to invest, when you want to start your investing journey. And like I said, when you place your order, you can rinse and repeat. The first step is the investment platforms. That is the first step on the journey, is choosing your investing platform. And there are so many investing platforms. But what are they? Investing platforms are like supermarkets. Think of them as a fund supermarket. Think of them as a Tesco or an Asda, where you can go to buy stuff and old investments in one place. You can sell it. They are designed for your own investment decision. In fact, think of them as a John Lewis. That's a better description, because they sell food, they have waitrose, they have the food hall, and then they have clothing, and then they have home, and then they have everything. Think of your phone supermarket like that. They give you easy access to many investment opportunities. It's a simple buying process. You can buy in 5 minutes, They provide tax-efficient wrappers, those accounts that you can buy your money, you can buy your things on. Now, think of those accounts as your basket. Do you want a basket or do you want a trolley? If you take a basket, you might pay more. If you take a trolley, you might pay less. So there's tax-efficient wrappers, and it's flexible to switch between funds. If you take bread and you don't want it anymore, you can put it back on the aisle and take butter. Or even after you've paid for it, you can do a return. If you buy a blouse in the shop and you've gone to try it and you don't like it, very easy. You can do an exchange of size. You can come back in and say, actually, this blouse is not my size. I want a bigger size. I want a smaller size. So there's little or no paperwork either. And they provide a lot of research and information. The issue I have with a lot of people is that we are not willing to dedicate 5 or 10 minutes to actually read the material on the websites. Instead, we will spend that time reading stories on Instagram and dropping comments, advising people other people's marriages, advising other people on their business, advising your boyfriend is not the one. Leave him now. Leave that boy. He's not going to marry you. Leave that girl. She's going to show you Pepe. Then you will move from there to comedy. Then you move from there to food. Then when you finish that one, after 45 minutes, you're tired. You're like, okay, you should go. But that same 45 minutes or 30 minutes, you could have spent it on your investing platform, reading a little bit more to understand. So these platforms provide extensive research and information. They update you if you are willing to visit them regularly to have a look. Now, in addition to investing platforms, just to mention, there are robo-advisors. Now, I mentioned earlier that think of them like supermarkets. If you go into the supermarket, does anybody follow you around shouting, buy bread, buy, oh, damn it, thanks for switching on your camera, buy bread, buy milk, buy oranges? Does anybody do that? Did they do that to you in the store? Because if they start doing that to you, there's a problem. Or they're following you around telling you, this is your shopping list. Why are you buying chocolate? Why are you buying chocolate drink again? Don't you say that you need to lose weight? And you're drinking wine. You know, nobody is following you around the store doing that to you. It reminds me of a story. I went to Tesco once with my daughter. She was about 3. Yeah, and we'd gone to Tesco to do some shopping, and we were walking down the wine aisle. And you know how 3-year-olds can be quite loud. There were quite a few people there. And standing there in the wine, my daughter pointed at red wine and went, "Mommy, look, your juice, your favorite juice." I started dragging her, dragging her away from the shop. Everybody was laughing because that's the one. It's your favorite juice. You drink it in the evening. I see you. So nobody is in the shops telling you what to buy. Nobody's in the shops telling you this is what you like or what you don't like. That's the same way with the investing platforms. There's nobody telling you what to do. They are designed for you to make your own investment decision. They are execution only. You need to know what you want and come in and buy it. And that's why I'm here, to help you know what you want, to help you decide what you want, to give you the information about what they sell so that you can go in and make the right choices. So I am the label on the bottle of wine and the label on your box of butter telling you this is what it means, this is why you should buy what you should buy. So now the investing platform are execution only, but then there's something called robo-advisors. Robo-advisors are for people who don't want to do that. You don't want to choose anything. The algorithm with robo-advisors will recommend a tailored portfolio for you based on your investment aims and attitude to risk. Examples are Wealthify, Nutmeg, Money Farm, and Wealthsimple. Now, what I want you to bear in mind is that this is a fully automated investment service. Once you are on a robo-advisor and you're giving your money there and they're investing it for you, ongoing portfolio management, you can't come and join the pie. You can't go to your Nutmeg account and be like, I need to copy Ronke's pie. No, because you're not the one choosing your investment. It's been chosen for you. They are there deciding it. You can't personalize it. You can't manage your portfolio at all. It's managed for you. Now, the beauty of robo-advisors is that it prevents you from doing emotional investing. It prevents you from responding to fears or FOMO. Everybody's buying one stock. Everybody's shouting about this stock. Let me go and buy it. No, robo-advisors don't allow you to do that nonsense. They do everything for you. All you have to do is set up your payment. It goes in and they invest for you. Now, when you are on a robo-advisor and they're asking you questions, answer those questions as truthfully as possible because they are trying to determine your attitude to risk. So a few months ago, I shared somebody's return. Somebody had invested through a robo-advisor and the robo-advisor had done really well and giving them a really good growth. So they sent me a screenshot. I shared it in my stories, which I do quite frequently. And somebody jumped in my inbox and said, I know that platform. I use that same platform. It's Wealthify. How manage this person has made 25%. My own is giving me 4%. I said the returns are based on time. They might have been in the market longer than you and their attitude to risk. She said, no, you said the person has been there for a year. I've been there for 2 years and I've made smaller interest. I said, that means you have a low attitude to risk and your money has been carefully invested to match your risk level. She said, no, how would they know my risk level? I said, they asked you some questions when you were registering. She said, no, they didn't ask me. I said, think. They asked you questions. They asked you like, oh, if you put your money into the investing and your money and you lose money, how do you feel? How will you feel? She said, I answered those questions. I said, no, I will feel bad, oh, I don't want to lose any money, oh, so they don't take away my money. I said, you just told them that you have a very low attitude to risk. You answer the questions without thinking about the answers. And that is how your money will be invested. So if you have a low attitude to risk, your money will be invested in more safer investments, which also will have or likely to have lower returns. If you are somebody who is aggressive, if I lose money, the Lord give it, the Lord take it away. I will make another one. Or, oh, I don't mind losing a bit. I really don't want to lose money. But if I lose a bit, I'm conscious that I can also make it back. But if you know that you're the kind of person that If you lose 20 pounds, you will start rolling on the floor and screaming, Jesus of Nazareth, where is Ronke's number? Let me call her. Because she's the one that taught me this investment. If you know you're that kind of person, then you need to be doing very safe investments. You must never ignore your risk tolerance level, because it is the biggest definition of doing past yourself. You must never. Some people will reach out to me and say things like, oh, Ronke, your investing is too safe. It's too safe. It's too boring. It's too safe. Your portfolio doesn't have this. Do you have this? Do you have? I said, I'm aware of those companies. I don't want them in my portfolio. I'm not 23. Like you are 23. It means that you have 40 more years of work. I don't have 40 more years of work under my. I'm already tired. So if I lose all my money today, I'm going to be cold. I'm going to be cold and poor. So I cannot buy those sexy companies that you're buying. Why? I have respect for my risk tolerance level. So you must always respect your risk tolerance level when you invest. Now, when you invest, you must be aware of these 6 points. Fees. Investing platforms have fees. Some of them have low fees because they carry very few instruments. They've streamlined their portfolio. They are strictly online. They are strictly apps. Moneybox is strictly an app. It doesn't have a website to maintain. Maybe they have small offices, or they don't have a lot of staff, or they don't carry a lot of US foreign instruments that have charges. Some of them will have low fees. Some of them will also have limited accounts. They will just have a small portfolio range. They will sell a few stocks here, a few bonds, a few funds, and they will rest. Then you need to think about those fees before you start investing. You need to think about what are the investment and account options. If you know you're somebody who wants to buy stocks, you want to buy Amazon stock, you want to buy Nvidia, you want to buy Google, you want to buy Eli Lilly, you want to buy all these pharmaceutical stocks, you cannot go and open an account on Vanguard or Fidelity Investor, because those ones don't carry stocks. They only carry funds, and they only carry their own funds. You cannot open an account on them. If you are somebody who likes to look for, interesting companies, the tiny, mid-sized, tiny, small cap American companies and investing, you cannot go and invest on Trading 212 or a small platform. You want to go to the big man at Grace Lansdowne that carries everything, but your fees will be high. You need to think about platform security. There needs to be robust security, two-factor authentication, not the one that you will just type 123, you are in. Because the same way you are typing 123, you are in. That's the same way the person that wants to swipe your money to will type 123, they will be in. So you need to think about platform security. What is the fund safety? Is the platform regulated? This is the most important point. Is the platform regulated by any financial body? I don't care who's telling you. The moment a platform is not regulated, the moment you cannot find their name on the FSCS website, you have no business on that platform. It doesn't matter who is pushing it. It doesn't matter if you know the millionaire that knows the millionaire that started it. That's not your business. You need to be on a platform that's regulated, because if that platform disappears, you want to be able to hold the UK government accountable for your money. And the UK government will give you back your money up to £85,000 on any platform that is regulated, if any platform that is regulated by the FSCS goes bankrupt or collapses. Not if you invest in something that's not doing well. That's an investment decision. But if the platform collapses or anything happens to the platform, you will get your money back. Is the platform accessible on mobile? Are you the kind of person that likes to do things on the go? You like to look at your money on the go, you like to invest on the go. You need to think about that before you jump on a platform. For a long time, Vanguard did not have a mobile app. You could not access Vanguard on mobile apps. And so a lot of us did not use Vanguard because we like looking at our money on our phones. You need a computer to look at your money on Vanguard. Vanguard now has an app which is basic, but at least you can see what your money is doing on Vanguard apps. How much research and tools do they provide? Platforms like Vanguard don't provide anything outside their own funds. They will provide all the information about their own products, and that's it. Nothing else. Grace Lansdowne will give you a truckload of information about the market. Trading 212 will give you information about the specific products that they are carrying. So you need to think about how much research and tools you want, if you want to go to different platforms for your education resources, or if you want to stay on the same platform where you are investing. So these are the kind of things you need to keep in mind when you choose an investing platform. Now, I think we are all based in the UK. We don't have anybody here from the US or Canada. So in the UK, these are the platforms. These are some of the platforms that are available to you. There are a large number of platforms that are not here. We are not limited to 12 platforms in the UK, but these are an example of different kinds. So number 1 and 2 are the platforms that carry most of the products you will find in the UK. AJ Bell is slightly cheaper than Agris Lansdowne, but these are the 2 platforms that carry everything. Trading 212, Moneybox, and Free Trade are super convenient. They are app friendly. They have very low fees, and they are young people are compliant. Trading 212 has the amazing pies where you can just build a pie. Sorry. Wow. Okay. Trading 212 has the pies that you can build, and you can then have a lot of investments with a little bit of money. So fractional shares, you can have them on Trading 212. Moneybox as well is just an app. It doesn't have a website. So of course they have low fees. Free Trade also has very low fees. There's something called Invest Engine as well. Barclays Smart Investor and Halifax Share Dealing are owned by banks. So Halifax Bank and Barclays Bank have these platforms, and their products are kind of geared towards what these 2 banks have as funds to sell. Now, Fidelity International and Vanguard only sell their own products. Both of them only sell funds, and they only sell their own products. So on Vanguard Investor UK, you will only find Vanguard funds. You will find VWRP, you will find VUAG, you will find everything will be VVVV something. Vanguard sells Vanguard funds. Now, Vanguard funds are quite popular. So I have got a Vanguard account, and I do have Vanguard funds because their funds are cheap and they perform really strongly, and they are well diversified. They also have ready-made portfolios. I will show you when I go on their website now, so you will see everything. And then we have Nutmeg, Wealthify, and Money Farm. These are robo-advisors. These are the ones that you just put your money in, and the investing is done for you. The portfolio is built and chosen for you. You don't have to do anything beyond just putting your money into the platform. Now, these 12 platforms are all FSCS regulated in the UK, which protect consumers up to £85,000 in the event of platform insolvency. Platform insolvency, not I bought Shogologo Bangushe and the shares have disappeared. Platform insolvency. We don't have US people or Europeans today, which I sometimes have. So the next thing I want to do now is take you to those platforms and show you what life looks like on those platforms before we take a break. Just give me a minute. I'll show you these platforms. Okay. Do we have any questions yet? Or should I just keep going? Okay.
Keep going.
Okay, thank you.
Actually, can I ask a quick question? Morning, Ronke.
Yes, please. Good
Yes.
morning.
So I'm thinking, just to clarify, in the event that there's a horrible meltdown in the UK financial markets, and somebody has investments in, let's say maybe 4 of these apps, the 85,000, right, is per platform. So it's not like the FSCS is gonna say this human being has invested all over and is due only 85,000. Is it per platform?
It's per platform.
Okay, cool.
It is per platform. If, let's say, all of them go bankrupt,
yeah,
it is per platform.
Okay.
Very unlikely. Before they go platform, the UK government will shut them up, because it's better for them to shut them up than to allow them to go bankrupt. Because remember, there are some people that have millions on those platforms. But I'm a very pessimistic person. So once my money hits 85K on the platform, I don't put any more money. I go to another platform.
True.
I move to another platform and I start my journey again. I was watching a movie recently. I think it was a series, and somebody sold their house. So that thing when you sell a house and you are trying to do an exchange for another house, and the lenders always make sure that if you sell a house, there is that transfer immediately with the other house and is a chain. Let me tell you why. Because if your money sits in a bank when you sell a house overnight without exchanging the other house, so the first house has paid you, they've paid you, but you've not passed on the payment to the next house. If that bank goes bankrupt overnight, you will only get £85,000. And that's what happened in the movie I was watching. This guy sold his family house, almost £1 million, and he didn't complete the chain. And he went to bed. And his wife said, why have we not completed the chain? He said, we'll do it tomorrow. What's the hurry? He woke up the next morning that the UK government, all the banks had gone bankrupt. People were queuing up at the bank trying to get their money. The bank gave him £85,000. He had already sold his house. He didn't have money to buy the next one. The other people just said, be going, you don't have money. And that was really clicked in my mind. That's the reason why when you do that chain, they complete it for you. So £85,000 is really what you have, So that's another reason for those of us that like to stash money in banks. You put 200K in your bank and you're just crossing your legs. You are taking risk. You are taking risk. So yes, so that is the interesting thing there. So I will share my screen again. I have the pages open now. I will just share my screen. Yeah. Okay, super. So the first platform we are going to go to is AgriLansdown, which is the pricey baby. But if you decide to invest on AgriLansdown as a platform, where you are going to go is this personal. That is what is going to open for you automatically. It's not going to take you to workplace. It's going to take you to personal. Now, on personal, you want to go to investing. And under investing, you want to go to stocks and shares ISA, which I'm going to talk about. So here you have the different kinds of accounts. You can have, when I talked earlier about baskets, these are the different kinds of accounts you can have on AgriLansdown. You can have a stocks and shares ISA, a fund and share account, a lifetime ISA, junior stocks ISA, bear trust account. When I talk about accounts later on, I will come back again and explain to you the different kinds of accounts. Now, when you come here, this shows you what you can buy on AgriLansdown. It can be shares, funds, exchange-traded funds, investment trusts like real estate investment trusts, gift and bonds, IPOs and new issues, venture capital trusts. They have a lot of things. Then they have ready-made portfolios that are ready-made. If you don't want to think about it, you can just choose from what they've already built, what their expert teams have pulled together as ready-made portfolios, and you can simply invest in it by telling them what you want. Do you want to grow your money? Do you want to receive an income? Do you want to save for retirement? So a little bit like the robo-advisor function is what they have when they say they have a ready-made investment portfolio, except that in this one, you can see what is in the portfolio. They will show you what is there. Now, I mentioned earlier that they have a lot of research and information here. So you will have things like investment ideas, which is, they will ask you can build your own portfolio. You can have a list, a short list here, where you can go in and look at funds that they have reviewed and they think are going to perform well over the next few years. These are usually mutual funds. Then you can also come here and get news and insights. Agrives is fantastic for news and insights. They will tell you what's happening right now, 5 no regret moves you can take before the autumn budget, what can S&P 500 teach us about long-term investing. There's a lot of information here. Take a minute once every week. Put aside the Instagram and TikTok and come here and read one article. Promise yourself one article a week and read it. And over time, you will find yourself. Don't read it with the plan of becoming an expert immediately. Just read it and leave it. It will rest in your brain. Over time, you will start seeing a pattern. Something will come back and say, I didn't read about this company 3 months ago. So this company is still doing this thing. Hey, so I had 5 months ago that we're doing that. Then your brain will start to build blocks. And it will start to settle in your head. And over time, you will know. 5 shares to watch in 2025. 5 funds for 2025. It's now a good time to invest in gold. There's so much information on AgriLansdown. I love hanging out here. It's a fantastic place to be. Now, there is also Trading 212, which is where I have a pie right now, which a lot of people are copying. And Trading 212 is very people-friendly. It's very easy to use. It's very small money friendly. Now, on Hargreaves, you cannot buy fractional shares. What's going on? You cannot buy fractional shares on AgriLansdown. You need to buy specific shares. You need to buy like a unit or 2 units of a share or a fund. With funds, you need like £100. With shares, you also need like 500, 700. In fact, if you want to buy the shares of Amazon or some companies, you need £200, 700. Eli Lilly, you need £700 for 1 unit of Eli Lilly stock. Now, 2212, you can invest with as low as £10. And they will even split your £10 into like 5 different things. I'm not sure what the logic is behind that, but they have fractional shares that they're selling. Now, when you come on 2212, you can see that the first thing they introduce to is an account called Invest. Avoid that account. What you want is the second account here, the ISA. Why? This Invest account pays tax. This is a taxed account. And I will explain it when I start talking about different kinds of accounts. So if you're planning to open an account on 2212, you don't want to open Invest. It looks familiar. It looks like common sense. Yes, I'm trying to invest. So of course, I'm going to open an Invest account. I don't have any business with the others. You do. The Invest account, you don't have a business with it. You have a business with ISA. Because this ISA account is zero commission investing, no account fees, and it's tax-free investing, which they haven't put here. They haven't mentioned it, but if you hover your mouse over it, you will see that it's saying invest in stocks as ISA with zero commission, invest tax-free. That's the main reason why you are here. You want to invest tax-free. Now, they've made it easier here because they allow you to build pies, invest tax-free. See? And you can open a pie, you can create a pie, you can copy an existing pie on 2212. And you can invest. When we go on the break, I will log in on my 2212 account and show you exactly how to create pies or how to copy pies and things like that on 2212 here. Now, the other account you can have is with Vanguard Investor. Why did I think I already opened it? Yes. So with Vanguard Investor, when you come here as well, Vanguard Investor also has different kinds of accounts. They have the ISA. They have the junior ISA, they have the general account. Again, you want to avoid general accounts. You are looking for the ISA. And I will explain why later on when we come back to talk about accounts. On every platform you are going to, the magic word for you is the ISA. That's the account you want to go for. Now, I mentioned earlier that Vanguard doesn't sell stocks. They only sell funds. They have a full list of funds. They have life strategy funds, which are funds of funds. They have target retirement funds. They have index and active funds. They are all different kinds of funds. They have exchange-traded funds. They have ESG funds. I will explain what funds are to you. Now, they also have information here. Learn about investing, choosing accounts, choosing funds, pension calculators, maximizing your allowance. They have a bit of information, not as much as you will find on Agris. They're not giving you news.
Sorry, Ronke, sorry.
Yeah.
Just not to bring you back because, for me who joined this is because I copied your pie, and it was my first time actually of going there, and you're saying we should do stocks ISA or cash ISA. Which one? Stocks.
ISA, yes. Because the cash ISA is just a savings account.
But your pie was where? That's the only thing I copied and put £100. So, and it's telling me that I have 96.92. Sorry, I'm sorry if I'm bringing everybody back.
No, you're not. The thing is that, like I said, Trading212 is an interesting platform, which I didn't use for a long time because of this. When you log into it, they will take you to this invest straight. So that when you copy the pie, they have made you copy it into an invest account. That is the account you opened. You didn't open an ISA. So it's your pie in an invest account.
Yeah, I think so. Because so how do I start it in this?
So the only way you can start it is to open an ISA account and start and copy the pie again.
Okay, that's stock or cash.
You can't put stock, you can't buy any assets into cash. Cash is a savings account.
Okay, so stock. Okay, let me
Yes.
just do it now.
Yes.
Okay.
So to everyone listening, there are two kinds of ISAs you can have, the stock and the cash. And the cash is just a savings account.
Okay.
Does that make sense?
Yeah, so I should just do it. Okay. Account setup complete.
I will get back to you on that because
Okay.
I'm still going to get to that. That's why I said I will log into my account and show you. So I will get into all of that and take you through. So just be patient with me.
Okay. Problem. Sorry,
On
everyone.
Vanguard,
Sorry.
no, it's okay. So on Vanguard, you also have the same thing. There's education, there's ISAs. You can have the reason why I love Vanguard is that you can just invest in a single fund. I will explain. They have things like, they have funds that are funds of funds, which means it's a fund that has a fund inside it. They have that. Then you go into AJ Bell, and AJ Bell is very much like Hargreaves in that they carry a lot of things. They have, again, you want to go for the ISA, which is the stocks and shares ISA, is what you want to go for, or a lifetime ISA. And then they also have news and insights. They have news and insights that you can come here to read. They can educate you as well. So these are two platforms that you can go to for a lot of education. My favorite platform for education is actually Yahoo Finance. But these platforms are easier for beginners to deal with because they have the information in small chunks that you can read. There's a lot of articles that you can read. They are designed for beginners to read and understand. So I will always encourage you to start with AJ Bell or Agis Lansdowne for news and insights, not to open an account with necessarily, but for you to learn about the investment market that you are in. Okay, so now we've looked at those platforms. We're going to take a little break, a little bio coffee break. It's 10 a.m. on the dot. We've done very well today. We've moved fast, which is fantastic. I'm going to give you a 15-minute break. We're going to come back at 10:15 and we're going to keep going. So please come back at 10:15 and then we can keep going. Welcome back from your break, and we're just going to progress with the class into the next part of the class. Before we do, I think I have, that's fine. So now we're going to go into tax efficient accounts. You will notice that when I showed you the platforms earlier, I kept saying these are the accounts that are available, these are the accounts you should avoid. And on Trading 212, I said you don't want to invest, you want ISA. On Hargreaves, I was showing you the different kind of accounts that were there. And I'm sure you're probably a little bit confused and wondering what are these accounts. Now, in the UK, we have something called ISAs, individual savings accounts. There are three types of ISAs that are quite common in the UK. The stocks and shares ISA, which is our primary vehicle for investing. We are always going to look for the ISA account on any platform you go for, because this is a tax-free investing account. Then you have the cash ISA, which is a savings account. Please take note of it. No matter where you see that cash ISA, it is a savings account. That's why it has cash in front of it to help you. It's a savings account. You put in cash. And then you have the lifetime ISA, which is designed for only two things: for pension, saving or investment, or for saving or investing to buy your first property if you are below the age of 40. So that is what those ISAs exist for. So we have these three kinds of ISAs, and I'm going to start you off with the stocks and shares ISA account, which is our primary investing account. If you go on any of these platforms, you want to look for the account that has ISA in its name. It needs to have stocks and ISA in its name. So if it's just ISA, click on it and see, is it saying stocks ISA? If it's not saying stock ISA, that's not what you want. If it's saying invest, general account, fund account, home account, friendly account, that's not the account you want. You want to look for the stocks and shares ISA account. It's because that account gives you tax-free investing up to £20,000. So every year you have an allowance of £20,000 allocated to you by the UK government. That is how much you can invest or save through your stocks ISA, cash ISA, or lifetime ISA. Your £20,000 is spread across those accounts. So it doesn't mean you have 20 for stocks ISA, 20 for cash, and 20 for lifetime ISA. That's not what I've said. What I've said is you have £20,000 that you can use across your cash ISA, your stocks ISA, and your lifetime ISA. And whatever you invest through those accounts or save through those accounts, you don't pay interest, you don't pay tax on any interest that you make or any capital returns. So if you have a stocks ISA and you invest in NVIDIA this year, and in 5 years your investment has gone from 10,000 to 3 million, all of that 3 million belongs to you. Zero tax. If you put in 10,000 and you decide to sell your stocks and you sell it for 100,000 later on, the 90,000 profit you have made, you will not pay any capital gains tax. If you do that with property, you will pay capital gains tax. If you buy property and you resell it in the UK and you make money, you will pay capital gains tax. On your stocks and shares ISA, there is no such thing. You can now operate multiple stocks and shares ISA in one financial year. In many years before in the UK, you could not. You could only have one. But now you can have more than one stocks and shares ISA in the UK. If I take you back to the platforms we were on a few minutes ago, you will see on AgriLansDown that the account you want to open when you go on investing, can you see stocks and shares ISA? We click on it. That's what you want to open. Invest for your future free from UK tax. Open a stocks and shares ISA. You click on that button, you open your stocks and shares ISA. Easy peasy, lemon squeezy. I don't want you to come back to me and say, when I got there, I didn't pick the stocks and shares ISA. I pick fund and share. Okay, what do? I will block you. Because the fund and share ISA is not your business until you have used up your tax-free allowance. You have a tax-free allowance that you want to use up. If you go on Trading 212 as well, this invest account is not your business. You want to come to the second one here that says ISA. Stocks ISA, not cash ISA. Stocks ISA, open an account. You open an account with Trading 212 with your stocks ISA, you get tax-free investing. If you go to Vanguard as well here, and you go to what we offer under Vanguard, you want to see Vanguard ISA. You don't have any business with Vanguard General Account. You have business with Vanguard ISA. You can see here, it says stocks and shares ISA. Open an account. If you go on AJ Bell, you can see investing. You can come here and see stocks and shares ISA. You can go directly under ISA and you still see stocks and shares ISA. You open that. You don't have any business with the general investing account. Why am I emphasizing this? Because a lot of you will still go away, open a general investing account, and then jump in my inbox and say, how can I transfer from my general account? You cannot.
Okay, sorry, Ronke. I'm so sorry, everyone. So how do I take out this money in this?
You cannot.
So it will just be there.
You can sell it. You can sell what you bought.
Get your money.
Collect your cash. And then put your
How
cash.
do I do that? Because the money is going down.
You can wait for it to go up and then sell it.
Why are you laughing at me? Who is that laughing?
Please don't laugh. That is why we are in class. She has not made a big mistake. There are people who have put in 10,000, 20,000 before even buzzing me. And they say, Ronke, the 20,000, what do I do? Block me, please. Just block me because you are not listening. You need
to tell us on Instagram now. So
yes, that's why you are in class. So you are clever. Because now the only thing you have put into that account is how much did you put to 20,000 pounds? See, that's not anything. Even if you sell that now, you're not losing money. You are not going to pay tax on £100. There's no tax on £100.
It has even gone down to 96.
Be patient. Be patient. We rise. When it rises up and it gets to like 110, 120, send it and move your money to your ISA account. But now you can go and start on an ISA account. I emphasize.
Yeah, I've done that already.
Good, a lot, because people make this mistake. And these platforms like Trading 212 don't make it easy. Because once you log on, the first thing it's showing you is that rubbish invest account that it's easy for anybody to just jump on and start doing. Okay. That's the first thing they do, but that's not where you want to go. You want to go for the ISA, the stocks and shares ISA. That's your baby. You have no business with any other kind of account on any of these platforms until you have used up your allowance. Okay. Now, that is the story with the stocks and shares ISA.
Just bring us back a bit. Yeah. Before now, I just put money in Vanguard and it was the general one because I thought that you couldn't do 2 stocks and shares ISAs. But now, are you saying that I should sell it and then take the money out and then put it into the stocks and shares? Would I be able to do that?
You can't do that. It depends on how much.
I have about 3K there.
Then you have to decide if you want to leave it there and pay the tax when it's time for you to take it out, or sell it when the market is doing well and put your money into a stock ISA. The most important thing is not to sell when you're not in credit. Don't sell when the money is not doing well. Don't sell when the assets are low. Sell when that 3,000 has gone beyond something else. And then usually you have a capital gains allowance in the UK. And I think it's £500 this year. So if your profit is not more than £500 on it, you won't pay any tax. Okay. But once you exceed that amount, you have to report it to HMRC and pay tax on it. And it's, remember, whatever that money is additional income on whatever income you're already earning. So if you're already past the minimum wage level, you're already past the 25% and you're in 40% band, then you're definitely going to pay 40% on that. So you just need to bear that in mind. Does that make sense? So with the UK, you need to use the stocks and shares ISA. This is a fantastic account that we have in the UK. I have clients in Germany, in Denmark, in France. They don't have tax-free investing. There's no tax-free investing in the US. The only country that gives tax-free investing is the UK. And so you have to use that account. You have to benefit from that. That is the advantage they are giving you because you've already paid tax on the money you are using to invest. The assumption here is that you are taking this money out of income that you've paid tax on. So you are trying to avoid double taxation. So if you invest with that invest account, or you invest with an account that is not an ISA, you are using accounts that are meant for, one, people who don't pay tax in the UK, so that they can pay tax on that income, or people who have used up their tax-free allowance and are now needing to use a taxed account. Now, if you are below the age of 40, you can open a lifetime ISA and use part of your 20K allowance to invest or save for your first property. If you are below the age of 40, you can open this account and get 25% bonus on whatever you put in. So I advocate for this account because I think 25% bonus is really quite a good interest rate to get every year, because there are very few investments that will give you 25% in 1 year. But the UK government is going to give you 25% on your money. Unfortunately, the maximum you can put in is £4,000. So if you're below the age of 40, between the ages of 18 and 40, you can open a lifetime ISA, put in 4,000, you get £1,000 from the government in every financial year. And when you are ready, you can use it to buy a property. So you need to open this account before your 40th birthday. Once you are 40, you cannot open this account anymore. So I can't open this account. And this account you can then use to buy property. When it's time to buy property, you don't withdraw it. You hand over the account to your conveyancing lawyer or whatever, who will then transfer the money to your bank. Any withdrawal you do directly will be considered you just taking out money, and then they will collect back any bonus that they've given you. So whatever you put into the account, this account uses part of your ISA allowance. Please bear that in mind. Once you put 4,000 into this account, you only have 16,000 left to use in your stocks and shares ISA. You need to think about that. After you bought your first property, you can continue putting money into this account and getting the government bonus until you are 50. Once you turn 50, you will not get the government bonus anymore. Your money will still be in that account for another 10 years. So you need to bear that in mind, because then your money will just sit in the account for 10 years. You will not be able to touch it. You will not be able to increase it. It will just be there for 10 years, and then you can start taking the pension. So this account serves two purposes: first, property, and pension. The third kind of account you can open. So let's say you've used up your allowance. You can have a self-invested personal pension account, which just allows you to add more money to your pension pot. And everybody gets a £60,000 pension allowance every year. Your employer, if you are employed, uses part of that allowance. Every time they put some of your salary into your pension, they are using part of your allowance. And you can always see how much of your salary is going into your pension from your payslip. You can multiply that by 12, you know what is left, and then you can top up your pension yourself as well. The beauty of this account is that you can access it from the age of 55, or I think 57 now from 2028, which is still lower than the state pension age. So if you're somebody who wants to stop working before 60, you might want to get a personal pension account so that you have something to spend until your government pension kicks in, which is, they keep moving the date on that one. They want us to be coming to work with our dentures and walking stick by the time we are 70. But some of us will not allow that to happen to us. So you can have a self-invested personal pension. If you're a contractor who is paid through a limited company, Your company can pay into your pension, and there's no limit. As long as your company is paying directly from the company account to your pension. The company cannot pay from your company account to your account, and then you transfer. That's a salary. It needs to go from your company account straight to your pension account as a company contribution to your pension. And then when the company does that, then you can invest the pension and manage it.
Yes.
The thing about pensions is that once the money goes in, it can't come out until you are 55 or 57. You can't change your mind. So if you are trying to type £100 in your SIP and you mistakenly add an extra zero because you were shouting, hey, stop noise, Johnson, mommy is busy, and you type 1,000 and it goes in, that's it. It's gone in. It's not coming out till you are 57. So your SIP is actually a pension account that you are managing yourself. You can put in money, you can buy stocks with it, and the government always tops up with 20%. That's the beauty of it. So if you put in £80, the government will add 20, making £100. This is the beauty of SIP. So even if your company puts in money for you, the government will still top up as well. So that is the advantage of SIP, especially for people who are doing contracts. It always baffles me when people say, I'm a contractor, I don't have a pension. What do you mean? What do you mean? You are busy making up expense receipts to use up the money when your company can easily pay into your pension, but you are busy looking for ways to expense things that didn't happen. When you could easily just pay into your pension, at least secure the future. You don't need to save. If your future is already secure, then you can spend the small salary you are collecting, knowing that you don't need to do any extra. But a lot of people don't know that. So I'm here to tell you that you can invest through your SIP account. Now,
a quick question, please.
Nest a SIP?
Sorry?
Is Nest a SIP?
Yes.
Okay.
Nest has a SIP. Nest is private pension.
Okay.
Yeah. Nest is private pension. So you can have a private pension account, yes. Okay. So with Nest, if it's a private pension account, you're not the one managing it.
Yes, I'm not.
Exactly. So that's also valid. So you can also have that as well. But a self-invested personal pension account, you are the one managing it. Nobody's managing it for you. It's very much like your stocks and shares ISA, that you have to choose your stock, you have to choose your ETFs, you have to choose what is inside.
What platforms would you are there for SIPs?
Agri's Lansdowne.
Okay.
Used to have a SIP. They don't seem to have it anymore. That's interesting. Agri's Lansdowne used to have a SIP. Vanguard has a SIP.
Okay.
Because I have a SIP with Vanguard, so I know. So this is the Vanguard personal pension account is a SIP account. Yes. So this, can you say, is SIP? So Vanguard has a really good SIP, and they also have retirement funds that you can just put money into there. So self-managed, managed pension, personal pension. We do it for you or do it yourself. And then AJ Bell also has a SIP. So under their pension, you can see self-invested personal pension and ready-made pension. You can even have pensions for your children so that when they go old, they can spend money that mommy and daddy left for them. So yes, so you can have.
Can you hear me?
Yes, I can hear you, Buki.
Sorry, quick question. So yeah. I just want to be clear of how this SIP works, right? Because I haven't got a private pension at the moment. So let me ask a very basic question. If I start a new job tomorrow and they're saying that they're going to pay me 12% into my pension, right? Am I to open, like, let's say a Vanguard SIP account and then give them the account number?
No, you don't have to do that. If they say they're going to pay into your pension, they probably have an arrangement with a pension provider, which means they will pay 12%, and they will match it. So there's something called matching, which employers do, which if you put in money, they put in money. And some put in quite a chunk of the money. You just need to make sure that the pension provider exists. They give you the login details and details of your pension so you can access it. And that's it. So with your workplace pension, you don't need to do anything extra. Just make sure that you opt in and you max out your pension as much as possible, put in as much as possible, because then they can, or as much as they will match. So if they will only match 10%, you can choose to just put in 10%, or you can put in more. I always put in the maximum because it reduces my tax. Whatever you don't put in, they will tax. Because they remove pension contributions before tax, yes.
Okay, and then all this, the second question, this Vanguard and AJ Bell, is there a minimum? If somebody opens a pension account, SIP account today, is there a minimum? Can you, is there a minimum? 2, must you make a monthly contribution, or you just open
No.
it and leave it there?
You can open it and leave it.
Okay, great.
I think with Vanguard, they've increased their opening to, I think, 500, which is quite a huge chunk. It used to be £100. When I did it, it was £100. But later on, I've heard from people now that it's £500 to open an account. And I suspect it's because people open and abandon empty accounts all over the place. So let's see. But it's usually about £100 to open most of these accounts, and then you are good to go. And then you don't have to you're not obliged to make monthly contributions anytime like that. So this one says start investing with a monthly payment of £100 or a debit card payment of 500. So if you're going to do a one-off payment, it has to be 500. If you're going to do a monthly payment, then they will say £100. Now, this monthly payment, you can start it and then cancel it after you've done like 2 or 3 payments, and then you can decide that you don't want to do it anymore. Then you can cancel it. That's also possible, So, but you can get started with 500.
Okay, thanks so much for that. Sorry to take us back, just to go back to the ISA, right?
Yes.
Now, the ISA is maximum of £20,000, is it?
Yes.
Okay, is that £20,000 split between cash and stocks and shares, or per type?
No, it's not per type. It's split between cash, stocks, and lifetime. Those 3.
Okay, and then also
Yes.
to confirm, because I already have a cash ISA account. So
Yes.
in other words, it's watching the amount I've paid into that account. If I go and open another one now, it won't allow me to exceed that maximum of 20,000, right?
So because if you don't open it on the same platform, the new platform that you go to open an account in, they won't know how much you've put into your cash ISA. You are the one who needs to know. So if you're on the same platform, they will be tracking. If you have a cash ISA on Trading 212 and you put in 4,000, Trading 212 automatically will tell you that you have just 16,000 left. But if you have your cash ISA on Trading 212 and you go and open your stocks ISA on Agris will tell you that you have 20,000 because they're not aware of that 4,000 you've put somewhere else. So the onus is on you to make sure that if you add up all your contributions in this financial year, just 1 year, it doesn't exceed 20,000.
Right.
Now remember, it's just 1 year. So it's just from April 6, 2025 to April 5, 2026. What I do is that if I find that I have more money than 20,000, which has happened to me before, I will put in the 20,000 and I'll just wait till April 6. And then I'll put in the next amount. So just wait a little bit to the next financial year and start putting in money as well.
Thank you so much for that. Thanks.
Fantastic. All right. Good stuff. Do we have any other questions before I progress? I'm very happy to go back as much as you want. That is why you are in class. So there's nothing like, there are no stupid questions. In fact, I want the questions now. Let's trash it out again and again that we are all clear, because I want you to be able to take action.
So my question is, so the 20,000 per year is, say for instance, I have 4 stocks and shares ISA. That £20 is across all of them.
Yes.
Not per stocks and shares ISA.
No.
Okay.
No.
Okay.
It's across all ISAs that you have, not just stocks. It's across all ISAs, stocks, cash, license. It's across, or add up everything you have in anything that has an ISA in its name, and it must not exceed £20,000 in that financial year. Yeah.
Okay.
Yeah.
Can I go ahead?
Yes, please.
Please, for the lifetime ISA, the one where you put 4,000 and then the government puts 1,000, is it 4,000 per year, or for every 4,000 I put in, they add a 1,000?
No. So the maximum you can put in is 4,000.
Okay.
You can put in less. Whatever you put in, you get 25% bonus. If you put £100 in one financial year, the government will give you £25.
Okay.
If you put 1,000 in, they will give you £250. So it's whatever you put in that determines how much you get from the government. It's 35% of whatever you put in any financial year. Even if you put it in on April 1, 4 days before the year ends, they will still give you the full 25%.
Okay.
Yeah.
Thank you.
Now, with lifetime ISAs, you can't have multiple lifetime ISAs. Because some people will try to have multiple so that they can collect the 1,000 in different places. That's fraud. So you can't have multiple lifetime ISAs, but you can have multiple stocks and shares ISAs, as long as your combined contribution doesn't exceed £20,000.
And you can't withdraw that 4,000 at any point.
No. I mean, you can. If you withdraw your 4,000 from the lifetime ISA, the government will collect their 1,000 pounds with interest back from you.
Oh.
Yes. Is worth bearing in mind. Okay. Any other questions before we go on? Okay, so back to our class. I'm supposed to be on that break, but I'm not going to do that. We can go on. So now we know the investing platforms, right? We know the accounts we are going to open, right? Nobody's going to go and open a fund and general account. We are all going to open stocks ISAs and lifetime ISAs, right? Fantastic. So now you've opened the account, you know the account, you've logged in Ronke's stocking, you are looking at your account, it's looking at you. What are you going to buy? What can you buy into your account? What can you invest in? The first kind of investment I'm going to talk about now is stocks. Stocks, like I said at the beginning, is an asset that gives you entrepreneurial ownership. It allows you to own part of a business. You can buy and sell stocks on the stock exchange. So when you go to a platform and they show you a stock price, that is the public price of that stock. They are saying that is the price of a unit of that company based on the value, the perceived value of that company. And the perceived value of that company is based on the revenue, the profit, the quarterly returns for the last few quarters, how we think the company is going to do in the future, how the industry is doing, how the company is doing in relation to the economy. There's a perceived value. And so that price of that unit is influenced by economy, industry, market trends, company performance, and it can be volatile. It moves. When the market is not closed, you will see the price changing. When you are trying to buy a stock and they give you a price, they will tell you that you have the price for 30 minutes. Or they will tell you that you have the price for, it's never 30 minutes, 10 minutes. If you don't buy it, the deal will cancel because the price has changed. And the return you get on your investment when you buy stocks is dividends, which means the company makes profit, they give you a share, or the value of your stock increases and you can sell the stock unit for a higher price than you bought it because now the company has more value than when you bought it. There are different kinds of stocks. There are defensive stocks, which are the stocks of companies or industries that are not easily affected by economic downturns. Remember when we had COVID in 2020? That was a huge economic downturn. When COVID happened, did we all switch off our lights and go like, we're not gonna switch on the light and the TV? How many people did you switch off your lights like that and decide you're not gonna switch on lights? It didn't even occur to you. You cranked up the heating, didn't you? You were on your TV and YouTube and doing gym classes and running up and down baking bread. National Grid was doing fine because heating and light are essential services. In fact, stores like Tesco and Sainsbury were clearing out because we were eating, we had cash, we were not going out, we were not taking trains, our income was there, and we were able to shop and buy too much tissue as if we wanted to cure COVID with tissue, and we're doing all sorts of things at that time. Those companies were doing well. Because COVID was there, did people stop falling ill? No, people fell ill more because there was stress, there was anxiety, people caught COVID and they needed medication, people who had diabetes still had it, people who had asthma still had it, people who needed cancer drugs still needed cancer drugs, and people were having babies. People had babies. There was a lot of need for medical care, even though there was an economic downturn. What is my point? Some stocks don't lose value in economic downturn. They thrive. They are called defensive stocks because they provide the things that we need as people to live in the societies we are in. And then we have cyclical stocks. These ones are tied to economic cycles. They experience fluctuations. We patronize them based on how our pockets are doing. Holiday companies. Nobody goes on holiday when they are broke. Nobody goes on holiday when the times are not looking good. Everybody sits tight and says it's not time for holidays. So Marks and Spencer will suffer. All those kind of John Lewis, they will suffer because who wants to buy? Is it now that I want to buy coats? Where am I going that I'm buying shoes? I'm not leaving the house. I don't have a job. They're telling me to buy the Le Creuset pot. I can't buy any Le Creuset. So these are cyclical stocks because they are things that we buy as a luxury. And then we have something called growth stocks. These are companies that are expected to grow revenue and earnings at a higher rate than normal compared to other firms due to what they are doing now. Examples of these are technology companies, AI companies, semiconductor companies, data center companies, companies that are doing cutting-edge technology that we are all taking up and we are using very crazily. These companies are expected to grow fast. The likes of NVIDIA, AMD, SML, TSM, Meta, Alphabet, these are companies that are doing forward-looking technology. They are good companies. They rarely pay dividend because when they make profits, they turn it back into the company and use it to grow the company more. What you get instead of dividend from this kind of company is capital appreciation. Your money, the value of your stock grows. And the next person that wants to buy it after you has to pay more. And that's how you make money because other people then want to buy the stocks. Now, just to give you an examples of stocks you can invest in. 3 stocks that had 20% average annual return in 20 years. NVIDIA, Netflix, Amazon, Apple. Fantastic. In fact, NVIDIA had 50% average annual return in the last 10 years. It's not even 20%. It was 50 in the last 10 years. So some of these stocks have done really well. And based on my own research and my own study of the market, I'm convinced that these stocks on the right have strong growth potential over the coming years. Some of them I will have taken off. I put a star beside DocuSign and AppLovin Corporation because I'm still looking at them. I'm thinking, I want to take them out. I want to replace them with Grab and Snap or one of those kind of things. But you see, the first 5 or 6 of these stocks are stocks that I believe continue to have strong growth potential, and they are in the growth. They are good stocks, and they are expected to continue to have high growth and high earnings and revenue over the next few years. Now, if you don't want to buy stocks because stocks have higher risk level, because what you are doing is trusting one company to grow. You are saying, I believe in you. I want you to grow. I know you can grow. I'm putting my money into you. What if you don't want to do that? What if you believe in 5, 6, 7 companies, but you have only £500, and each company costs £500 per unit, and you have only £500, and you want to spread your money across 5 or 6 companies that you believe in as a group, not just one? This is where things like funds come in. Funds, not just mutual funds. Funds in general are monies pulled together to spread across different stocks or bonds. They are like hamper baskets. So instead of you buying a box of tomatoes, you buy a can of tomato, a can of milk, a can of this, a can of box of chocolate. Then there's a little hot chocolate drink in there. There are some cracker biscuits in there. So instead of buying a box of those things, you've bought individuals of those things because you want to have a little bite of them. I think of funds as pizzas. Imagine that we are all hanging out, all 6 of us, and all 7 of us, and we all have 7 different pizza interests. Some of you like meaty, mighty meaty. Some of you like vegetarian. Some of you like margarita. And some of you who are Philistines, you like the pineapple thing. And some of you like something else. And we want to all have all of those pizzas, but we don't want to buy 7 pizzas. So we pull our money together and we buy one pizza that has 7 different flavors in it. You know those pizzas where they say half and half. And so we buy a half and half pizza. And now all of us can get a little taste of all the different pizzas, flavors that are there without putting all our money on one flavor. That is how funds work. And a mutual fund is a fund that is actively managed by professional fund managers. It's traded daily through fund platforms, not the stock exchange. There is a little bit of a fee, and the desire of that fund manager is to outperform the underlying stocks that make up the fund. Sometimes a fund can track an index or industry, and a fund can have stocks in it and bonds as well. When you buy a mutual fund, you need to consider the fees. You need to consider the underlying material or the underlying assets within the fund. Very important. So there are 2 things I want you to take note of when it comes to mutual funds. They are not traded on a stock exchange. They are actively managed by professional fund managers. Be aware of those 2 things. It also means that because they're professionally managed, they can have a slightly higher fee. So imagine that all of you in this room pull your money together and give it to me and say, oh, Ronke, invest it for us. I will take a fee. I will take a fee out of your money. And because I'm a human being managing your funds, and my fee might be a little bit higher because I'm working hard actively to give you a return on your money. So mutual funds can sometimes have higher fees. A lot of platforms now try to make their mutual funds as cheap as exchange traded funds because they realize that people are running away from mutual funds and going into exchange traded funds. Now, exchange traded funds are simply funds that are not actively managed by a fund manager. They are passively managed and they track a specific index. So they don't need somebody managing them because they already track an index. They only follow the behavior of that index. What is an index? An index is a measurement that's been set up to measure the performance of a group of companies. So, for example, the S&P 500 is an index that measures the performance of the largest 500 companies in the USA. The FTSE 100 index is an index that measures the largest 100 companies in the United Kingdom. So if a fund says is an exchange traded fund that is matching or tracking the FTSE 100, it means it will invest only in the largest 100 companies in the UK, and it will invest in them in a proportion that matches the ranking of those companies in the 100 list ranking that they have. So if that fund will not have 20% in the smallest, in number 100, no, it will have more in the first 10 funds, in the first 10 companies on that list, and then it will reduce its percentages as it goes down that list. So it's passively managed. It's also available on the stock exchange. So these ones are very easy to buy and sell because as long as the stock market is open, you can buy an exchange traded fund. So an exchange traded fund is different from a mutual fund in the sense that it's passively managed, is available on the stock exchange, and so sometimes it tends to have lower fees or expense ratios. You can buy exchange traded funds that are tracking the oil sector, REITs that are tracking real estate investment trusts that are made up of technology stocks, semiconductors, defensive stocks, and so on and so forth. If you're someone that copied my pie or you are aware of my pie, you will notice that in my pie, I said my pie has 3 ETFs, exchange traded funds. It has an ETF that tracks the broad market, the whole world. It has an ETF that tracks high dividend yield companies that pay dividend income. It has an ETF that tracks the AI sector, very volatile, or it tracks the AI sector. It's made up of NVIDIA, ASML, TSM, and so on. And then it has a hero stock, which is Palantir, which is an AI stock. So exchange traded funds have that difference from mutual funds. And now on this screen, I'm sharing with you my favorite exchange traded funds. Now, number one is an exchange traded fund that tracks the S&P 500, invests in the largest 500 companies in the US, and has been profitable consistently for almost 40 years. It has 2 versions, VUAG, which is accumulating and reinvest your returns, and VUSA, which pays you dividends. The iShares Core MSCI, which is SUIDA, is a broad-based ETF, very much like the VWRP I mentioned earlier. It invests in the developed world. The EQQ invests in the NASDAQ 100 and is a very technology-based ETF and allows you to invest in the largest 100 companies in the US, 100 non-financial companies listed on the NASDAQ stock exchange. So there are no banks in there. So they are largely technology companies, EQQ. And then you have the S&P 500 technology. So the IITU is very much like the number 3 and number 5 are very similar, except that number 3 is concentrated, it's 100 companies. Number 5 is 500 technology companies. And then you have, of course, the FTSE 100 in the UK, which is the largest 100 companies in the UK. You have the Emerging Markets Fund, the EMIM. You have the Dividend Aristocrats. If you're somebody who is looking for income, then you have the USDV. Then you have the IUKP, which is a fan favorite of mine. If you're somebody who wants to invest in property sector, but you don't want to buy individual real estate investment trust, IUKP is my go-to. And then you have the automation and robotics, which is a bit volatile. Then you have bonds. So the iShares Core UK Gilts will invest you into the bond market, which has a lower risk level than mutual funds or exchange traded funds or stocks and shares. Then you have the global aggregate bond as well, which is the AGG, which is another thing that invests in the bond market. And number 13 as well is a bond ETF as well. So what I've shared with you is my go-to list of funds that I like to invest in on the stock market. Then we have something called bonds. I mentioned earlier on in my list of favorite ETFs that we have something called bonds. So we from number 11 to number 13, we have bonds or bond ETFs, which allows you to invest in bonds. Well, what are bonds? Bonds are fixed income investment. They are basically like a loan that you are giving to an entity, and that entity is either a government or a corporation. Now, in the UK, if you give a loan to Starmer's government, you are buying UK gilts. If you do it in the US, you are buying treasury bonds. In Germany, it's called German bonds. We have them in Nigeria as well. They are called treasury bills or treasury bonds. And then if you do a short-term maturity one, they call it a treasury bill. Now, the thing with fixed income investments is that they are very low risk because they tell you from the beginning that this is a 5% bond, this is a 3% bond, and you know exactly how much you are getting at the end of the maturity of the bond. And you can buy them directly through the UK Department of Debt, or you can buy them through your investment platform. Now, on the right, I have talked about premium bonds, which are completely different. They are not a loan. Premium bonds are you basically saving your money in the savings account of the UK government. And they are saying that because this is the safest place to save your money, it survived 2 World Wars. We don't pay any interest. We don't pay any interest. They are the one that's chosen to put your money in our savings account for safety. We don't pay any interest, but we will enter you into a lottery every month, which you can win up to £1 million. That's the only thing. There is 100% protection for your money. It's backed by the UK government, and you can put in up to £50,000 into the premium bond account. With treasury bonds in the US, you can also buy that directly from the US government, treasurydirect.gov, or you can simply buy bond ETFs like I showed you earlier here, number 11 to 13, you can simply buy bond ETFs and you're already exposed to either the UK market with number 11 or the US or global market with number 12 and 13.
A quick question.
Yes.
Premium bonds. Are you telling me if you put £50,000 there and come back in 2 years, it's still exactly 50,000, not even the regular savings interest rate of 3%?
It's exactly 50,000.
Right.
Yes.
Thanks for letting us know.
So there's no interest on premium bonds in the UK. It's a very dodgy one. The interesting thing is that the older generation in the UK love premium bonds. It survived 2 World Wars. So people who are very skeptical will put money in there. I also think that it's a great place to stash emergency funds. It's a great place to stash money that you want to be able to access urgently, but at the same time, you don't want to be able to access it when you go to Tesco because premium bonds don't give you a bank card. Because when you save money in places where you have a card, they're not ready. You will spend it. But with premium bonds, the money needs to be moved. It takes 24 hours, it takes 12 hours before your money will get to where you need it. Premium bond statements are accepted by banks, they are accepted by mortgage lenders, they are accepted by all of those platforms that need you to show proof of funds. They are great for showing proof of funds. So you can stash money in there temporarily before you move it somewhere. It's always better than stashing 200K in a bank account. I'd rather stash 85K in the bank account and stash 50K in the premium bond account, and I'm waiting. Then my money is in 2 different places temporarily. Do you see what I'm saying there?
Yeah, I see it. Quick question. This is a good thing to ask. That is there any of the equivalent of a euro bond that exists in Africa?
So are you asking if we have it in the UK?
Yes.
So if you go to the premium bond website, the NS&I website, premium bonds are not the only thing there. This is very easy. So we are here now. I'm just going to go to the NS&I website now. You will see premium bonds is just one of the products that they have. So they have the premium bonds which doesn't pay any interest, and then they have bond products that do pay interest. So we are here. So you have premium bonds here. CO products. Then you will see the other products that they have. See, so in addition to the premium bonds, then they have guaranteed growth bonds, which is the savings bond. Those ones pay interest. You can see the interest rates on these bonds. Then they have a guaranteed income bond here, which also pays interest. So they have bond products, British bond products that you can buy. They have income bonds that you can buy. which also pays interest here. So there are green savings bonds that you can buy, which are environmentally friendly. So they have bond products that you can buy that pay interest, not just the premium bond.
Sorry, I'm seeing that the highest interest I saw on that page real quick was like about 3.8. Now, if you have an ISA that's already paying you 3.8, what would be the benefit of going for a bond product that is not even paying?
I've answered your own question.
You've answered it, Abby.
Yes.
It's just safe, it's just there. Okay. So there's no risk.
The reason why it's paying 3 point something now is because interest rates, cash ISAs are paying more. There was a time 2 years ago, those bond products were paying 1%.
Wow.
1%. So that's why I said it has a lot to do with your risk tolerance. Some people have zero risk tolerance, and they are paying the price in terms of their interest rate. The lower your risk, the lower your return. The lower your risk, the lower your return. If you are willing to take a little bit more risk, you are going to get a little bit more return. Earlier, 3 weeks ago or 4 weeks ago, in fact, it was 2 weeks ago, I shared the account of a lady who put in £20,000 into a stock ISA in 1 year, and her money was now £36,000 or 35. She had made over £11,000 from the stock ISA, and everybody was shouting, "What did she invest in? What did she invest in?" And she put majority of her money into Sophie Technology. Very risky, extremely risky, because that company could have crashed. And then she put a little bit of it in other things. That was her own risk level. It paid off. After sharing her view, I said to her, "Sis, are you going to sell those things now? Are you going to take out your profit? Or are you going to still wait? Because now you have 200% return." So do you see where I'm going?
Yes,
The premium bonds account is very low interest, but it's also very low risk, but also very low returns as well.
Please, I have a question. Sorry to so I'm trying to open the trading 212 account.
Yes.
Yeah, and then I've done the ID verification, and it takes me to a place that's talking about reduce your tax on US dividend. I don't know if what I've done.
Yes. And it's asking you to fill out a
yeah, we
Ben.
And they are different. I'm eligible under a treaty with the UK.
Yes.
I'm eligible under a treaty with another country. I'm not eligible and don't want to use a treaty.
You are eligible under a treaty with the UK.
Okay, thank you.
Because you live in the UK.
Okay, thank you. I just wanted to be sure so that I don't go.
It's important to always fill out your W8BEN form so that you don't pay extra tax. Yeah, because that W8BEN form allows you to avoid tax on US stocks, even though you are in the UK.
Okay, thank you very much.
So if you choose to buy bonds in the UK, you are buying government bonds. They are called yields, and you can see the prices on the right. And see, that's the interest rate I was talking about that earlier. Can you see the interest rates I'm looking at here now? In 2024 and 2025, can you see any 3% here? You can see that some are even paying 0.125 interest. Not made up. It's not even up to 1% that the UK government is offering on bonds if you decide you want to buy bonds. That is how low the interest rate can be, but your money is very safe. Now, if you don't want to buy bonds, you can also buy something called real estate investment trusts. You're somebody who is interested in property, or you don't want the stress of landlord, a property agent, Saturday morning, my boiler has broken, come and open the back door, something is happening to the fridge, all of those things. You can invest in real estate property, commercial property, residential property, and mortgages without direct ownership. Real estate investment trusts allow you to invest in properties that you normally cannot afford. NHS trust hospitals, bank buildings, shopping malls, warehouses, and they are traded on the stock exchange as well. And they are required to pay out 90% of their profits to their stockholders, shareholders every year. That's how they reduce their own tax in the UK. Now, if you don't want to buy just one REIT, you can buy a REIT ETF, which is a fund that has different REITs within the basket. And that was why I mentioned that I have a favorite property REIT called IUKP. IUKP is an ETF that is invested in the property sector. That's number 9 here. And it's invested in the property sector and allows you to have exposure to real estate investment trusts without you having to buy a single one. And then you get rental income, you get capital appreciation, you get dividend payments really. And a lot of real estate investment trusts pay dividends every quarter. So if you're somebody that's looking for income, they can be quite good. Now, bear in mind, they do not have returns that are as high as growth stocks. Now, the other thing you can invest in, the other asset is commodities, which are gold, silver, oil, soft commodities like agricultural products. You can also buy them on exchanges, commodity exchanges. You can buy funds that are based on gold. You can buy funds that are based on mining companies, gold companies. Prices can be volatile as well. But in the last 3 years, gold has done really well simply because the economies of the world are troubled due to the war in Russia and the Israeli issue going on and the orange man in the US doing what he knows how to do. Economies are unhappy, investors are unhappy, they don't trust currency, so they are buying gold. And because of this, the price of gold has gone up consistently in the last 3 years. So my sisters would like to go to Dubai. Your gold has gained value. I always say to people, before you buy designer jewelry that's not gold, go buy gold. Before you buy Gucci bracelets, go and buy gold. The one that they will wait for you, go and buy it. Because even though you will pay artisanal fees, gold is still gold and the value is going up. So yes, your gold is an investment. It grows in value when you don't do anything. You can shine in it and still be growing your investment. I had a friend whose mom was terribly fashionable when we were growing up, and she collected gold. And we all thought our mom looked a little bit, not very posh, because she wore a lot of gold. And it was always real gold. And then along the way, their dad had financial issues. And our mom was able to sell enough gold to pay for my friend's medical school, to pay for her brother's education, to pay for all sorts of things just from gold, because the gold had increased in value over the years. So gold is a tangible asset with intrinsic value that you can put your money to. You can buy gold bars as well, or you can just invest in gold through the stock exchange. I think the problem for me with buying actual gold is that you can lose it. If you're not careful with your gold asset, you can lose it, it can be stolen and things like that. But if you are somebody who wants to buy gold on the stock exchange, you want to buy gold through your investing platform so that nobody knows what's going on because you have a lot of gold. You can buy iShares physical gold, exchange-traded commodity. You can buy all these gold commodities that I have mentioned here. You can invest in gold mining companies. Now, bear in mind, again, it's a volatile asset. But right now, it has not been volatile in the last 3 years. It's just been going up, up, up. So you can invest in gold mining company ETFs as well, and at least use it to diversify your portfolio. So it's a great way to kind of bring something else into your portfolio instead of just stocks and shares. Yes. There you go.
Ronke.
Yes.
This gold mining, this recent one you just mentioned,
Yeah.
It would give it the same value, or it's still like investing on physical gold, like the gold bars?
So the first three are invested in physical gold. They are actually based on physical gold bars.
Okay.
On the price of physical gold bars. So if the physical gold prices increase, they also increase in value accordingly.
But you can buy them online, so
you can buy them through your investing platform.
Yeah, okay.
Yeah. If you're somebody who wants to buy actual gold bars, I have a plug, Abi Oloyede. She's sold gold bars for years and she still sells gold bars. I'm happy to connect you with her, but that's you buying gold bars. Then you have to pay for storage and then you have to, all of those things. You can collect your gold bar or you can pay for it to be stored as well. That option is there for you as well.
Okay.
Another question.
Yes.
So say somebody buys gold or these type of investments through their platform. Yeah. Technically, it means that I'll have to continue to monitor it, because at the end of the day, if it goes down, who's going to notify you that you are losing price, right? So it's very risky because you have to consistently monitor it yourself. Monitor monitor the prices of gold
on the platform.
Yes.
Why do you want to monitor
or generally, like I don't know, in the news or whatever, you have to be checking, because you don't want your value of £100 worth of gold bars today to become £52 tomorrow.
If it does, why do you care?
Because I've lost money now.
No, you haven't. You have only lost money at the point of selling. That is when you lock in the loss.
Okay.
Whatever goes down will come up. Whatever comes up will go down. During COVID, my shares lost half of their value. Half.
Did you sell? Obviously not sell at that point.
Never. No.
Okay.
I didn't sell. What did I do? I didn't say the app. I looked away. You look away, the market will recover. Yesterday night, I lost £1,000, £1,000, because Trump didn't get his Nobel Prize. As long as you don't sell, you haven't locked in the loss. That is why the market moves. If it's an asset you believe in, when the price dips like that, I buy more. I buy more because it means it's like a discount. If I'm planning to load my portfolio with NVIDIA, for example, and I have a portfolio where I put in 200 every month into my investment platform. I just put in 200 every month, no matter what, because that's called dollar cost averaging. So I put in 200 or 300 pounds every month, invested into a broad-based ETF like VWRP every month. Come rain, come sunshine, that's investing. Now, I also then put £1,000 aside, and then I set an alert on my phone for maybe NVIDIA or Eli Lilly that Yahoo Finance, please alert me if that stock drops by 5 or 10%. Why? Because that's a stock I'm interested in acquiring over time. So my normal investment is going on. When that thing drops, what do? I go and mop it up. I go and buy it. I check why it has dropped. Why has it dropped? Is anything happening? Did the CEO die? Nothing. It's just industry movement. I will go and buy it. So the trick is not to lock in your loss. If your gold drops in value, that's your signal not to sell. Now, the interesting thing about it is that gold is an asset that you use to hedge against the stock market. What do I mean? Most of the time, when your stocks are doing well, your gold might not do so well. But when your stocks are down, gold will be up. So what that means is that when other investors, their stocks have gone down and they can't sell, because nobody wants to sell when it's down. And so they don't have liquidity, they don't have money. Your gold will go up. At least you can sell gold and have money if you need money. That is why you buy. That's why you diversify your portfolio, so that you are buying different things, so that all of them cannot go down at the same time. If property industry is not doing well, oil and gas will do well. If oil and gas is not doing well, technology will do well. If all of them are not doing well, gold will do well. So that is what you do when you diversify. Because the idea is never to sell when the market is down.
Right, I get you. So yeah. What if there's a point where obviously you know that you're going to have to sell it at some point in your future? Maybe you need the money.
Yes.
You still have to be watching to know when it's really high, because high, there's different levels of high,
yes.
Right?
Yes,
so
you can set an alert. A lot of platforms allow you to set alerts that will tell you if your stock goes up 100%.
Right.
Even if you don't set the alert on your platform, you can do it on Yahoo Finance. If you have a few stocks, for example, with my own platform now, I have no plans of selling for the next 5 years, anything, because I'm still working. But if in 5 years' time, I feel like I'm going to start liquidating a little bit at a time, or even in 2 years' time, what I do is set an alarm. Any stock that hits 100%, which means it has doubled, I want to take out my own money and just leave interest. So I will set an alert. If the day I bought it, the price was £50 for that unit, I will set an alert that the day this thing hits £100, which has doubled, my alarm will go off. I will see it on my phone, it's gone off. It means I can sell. Some people also just invest and abandon. We invest and we check in on it once a year. Once a year, you come back in and check. You will see what is doing well. You will see what's not doing well. You keep your mind, okay, these two things, if they continue doing well, I will come back and sell them. Okay, these are the two things I think I can sell next year. Or do I want to sell, or do I want to allow them to keep going? How much profit am I looking for? Is 100% okay? It's not time for me to sell. So those are the kind of things you can think about. And also, to avoid this kind of thinking is why some people use robo-advisors, where you just put your money in and invest for you and you keep going. Does that make sense?
Thank you. I got it now. Thanks so much.
Now, I said earlier that you can choose your stocks, you can choose different stocks to buy, you can choose different assets to buy, but sometimes you don't know if it's a good time to buy an asset. You don't know if it's a good time to buy it, and that's why I built this app, because I want you to be able to say, I'm buying my assets at a good time. Okay, now is now a good time for you to buy NVIDIA. So I will go to my app. I will log into my app because I want this app to tell me now if now is a good time for me to buy this asset. If now is a good time for me to be investing in, for example, NVIDIA or Palantir or ASML or one of those things. So I'm going to go to the bottom of this because in addition to investing, this app allows you to generate a budget every month. You can generate your monthly budget. You can generate something to help you pay off your debt. You can come here and say, I don't know where my money is going. Please analyze my spending. It will do that for you. But today I'm interested in the investment guide on this app. So I will click on investment guide. And then I will come here and say the companies I'm interested in. So somebody said they are interested in NVIDIA. They're interested in NVIDIA. They're invested in Palantir. I'm also interested in Google. Maybe Microsoft. Any other names? You have anything you are interested in? Please give me suggestions.
Netflix.
Netflix, Amazon. Okay, set your goals. I think I want long-term. I want to have long-term growth. I'm looking for long-term returns. I want to come back in a few years and have money. I want aggressive growth. And I can tolerate some risk. Okay. Come on. Okay. So I'm not going to wait. This app is going to do all the calculations. It's going to read all the economic news. It's going to look at historical data. It's going to run risk assessment. It's going to look at trading patterns. I put in formulas myself. The formulas I use, I put in 20 formulas here. It's checking ROI, it's checking their earnings, it's checking their quarterly reports. And then it's going to use all of that to tell me if I should buy something or if I should just not buy it right now. So what is it telling me? It's telling me that NVIDIA is a global leader in AI and gaming. It's telling me about their numbers, about their PE numbers. It says it might be overvalued at its current PI, but because of its competitive edge and financial health, it wants me to buy it. You see where I'm going with this? Then he's looking at Palantir and says, Palantir finances are weaker than NVIDIA, but it's continuing to grow. It's an aggressive growth pick. I should buy it. What does it say about Google as well? Google is a buy as well. Microsoft is a strong buy. Can you see the difference? It means that if you are going to buy one out of all of this one, let Microsoft be the one that you are buying because it's a strong buy. Netflix as well is unfortunately is a hold. It's saying don't buy Netflix right now. The current valuation seems fair, but given the risk in a heavily competitive landscape, I will rate this as a hold. So it says today, as of today, don't buy Netflix. Amazon is a strong buy as well. Now, in addition to these stocks, he has also recommended some ETFs for you, Vanguard Growth ETF, ARK Innovation ETF that have a proven track record of good returns. So this is a fantastic tool to help you choose your stocks when you don't know what to buy on the stock market and you have money you want to invest. This will always do the job for you, and I'm continuing to improve it every week over the next few years, just so that my people can have the work done for them. So you have this app that you can download or you can get. It's a web app that you can visit and you can use to get insights into what you should be buying. Now, this is the pie that I have on Trading 212, and this is as of yesterday. This pie was, I don't know, it's 2 days old, and I already have 2% interest on it. So imagine that I put in £1,000. I already have like some good money on it, £20. If it was £10,000, I already have £200 on it in 2 days already. And that's because it's quite an aggressive pie. Like I said, I've got Palantir in at 30%. That one has already given me 4% return. So if I had put all of that £100 in Palantir, I would have 4% return now. It's a high risk stock. And then I've got the Global Intelligence Fund, which is also giving me a decent return at 1.89. But you will see that I have some very safe things in there. The All World ETF is invested across the world. So the interest is lower because it's safer. It's a fund, but it has a lot more things in it. The high yield dividend fund is even safer than the previous one because it's high yield dividend companies, which are the very, very big companies. They are not going anywhere. They pay dividends. They move cautiously. They have low risk. They've been around for a long time. You can see the interest. So the lower the risk, the lower the returns. So this portfolio right now is showing you exactly how risk and return operate together. If this is a pie you want to copy, please feel free to copy it. It's called the Zero to Growth pie. I have another pie on my profile called the 5-year growth pie, and this particular pie I have not made it public. It's a 5-stock pie, very dangerous. All 5 companies are nobody companies. They are unknowns. But you know how some people bought Nvidia when Nvidia was £5 and it's now £200, and some people bought Sophie Technology when it was £6 and it's now £150. That's the same way I have decided that these 5 companies are the companies that I'm going to buy before they become big. They are my lottery tickets. And I have that pie as well on Trading 212. Okay, so now we get to, I'm supposed to give you a break, but I think we can just power on and then we can have questions at the end of the class. Nice. So this is the part where we fight. This is the part where we fight. Look at these 6 things on my screen. They are not investments. Buy your nice car with your full chest and enjoy it. It's not an investment. Timeshare properties are not investments. Your designer clothes, accessories, your nice bag, your high-end jewelry, they are nice to have things. They are not investment. Your Bose headphones, your nice TV, the one that's flashing and turning into wallpaper, is not an investment. Home renovations for your personal taste. This one really upsets homeowners. They will go, I renovated my house, I put in new bathroom, I put in new toilets that increase the value of, is a lie. It's not increasing the value of your house. Because you have no confirmation that the next person that's going to be living will like the toilets that you have done or the bathroom that you have done, because now they have to remove it. You are the only person that likes your red fridge and likes your red kitchen cabinet. So, madam, your home renovation is not an investment. Collectibles without demand. Oh, this is the jacket that Bruce Springsteen wore to a show in 1984. They sold it to you for £10. Madam, if nobody is looking for that jacket, it's not an investment. This is the shoe that Michael Jackson wore when he danced, beat it. Auntie, if nobody is looking for those shoes, it's not an investment. If you cannot confirm that it's truly the shoe, you have no evidence, you have no receipt, it is not an investment. So these things are not investments. Please bear them in mind as you spend money on them. Some of these things, I don't even want you to spend money on at all. Timeshare properties, for example, I don't want you to spend money on them at all. Their validity is unverified. Now, before we go to questions and answers, I need people to answer some questions for me. Which investing instrument is a loan to the government?
Bonds.
Fantastic, thank you. Now, was that Busola?
Yes.
So you can't answer any question again. You can mark yourself safe. This instrument is managed by professionals and may have fees.
Mutual funds.
Mutual funds.
Bookie Booty beat you to it. So Bookie is marked safe.
You don't have to answer anything.
Bookie is marked safe. Carol, Maya, are you there? Dami, are you there? Yeah. You can buy this investment in physical form. Well done. No. Peter did this one. Okay, so Dami, Mayowa, you are the ones that are still outstanding, and Carol. Portfolio of assets traded on the stock exchange.
This one is hard though.
Is it ETFs?
Who said it here? Dami, you are marked safe. Portfolio of assets traded on the stock exchange. Dami is marked safe. Mayowa and Carol, you're going to get homework if you continue at this rate. Provides exposure to real estate markets.
This is
between Mayowa and Carol.
What is the hardest one?
Harry sees or Harry eyes, yes.
Harry eyes. Who said that? Who said that?
I did.
But you're not supposed to. You were already marked safe.
No, they were not saying it now.
So you're not going to think about it now. It's real estate investment trust. Yes, it provides exposure to real estate markets. Real estate investment trust provide exposure to real estate markets. Okay, thank you very much, guys. You've done really well. Now, before we go, I just want to remind you to do your research before you invest. Don't invest in things you don't understand. Know your risk appetite before you invest. No matter how sexy something looks, if it's beyond your risk appetite, please don't invest in it. Assess the risk of every instrument before you put money into it. Make consistent investments. Diversify your portfolio. Please don't put your money into one thing. No matter how much you think is going to do well, please diversify your portfolio. Use your tax wrappers. I have warned you. If you come back to me next month and say you mistakenly invested through, I will just block you. I will just block you. So make sure that you are using your tax wrappers to invest. The financial year is from April 6 to April 5. So the current financial year we are in will end on the 5th of April 2026. Please build your emergency fund or savings pot. The UK has become quite an unfriendly place to people of color. It means that firing us is easy. Build your emergency pot so that if you have to change jobs or you have to be in between jobs, it doesn't derail your financial journey. Save up, build that emergency pot, sell the things in your house that you're not using, put them on Vinted, put them on Facebook Marketplace, make that extra money, stash it, hustle on the side, make that extra money, build your emergency pot. Pay off high interest debt. It's not a good time for you to have debts. This is not a good time for you to have numerous credit cards. The banks are not even giving good interest rates on credit cards now. So it's not a good time to hold on to debts. Please pay them off as much as you can. If you are employed, join your workplace pension so you can get matching. Join the workplace pension. If you are not employed and you're a self-employed person, open a self-invested personal pension account and see what you can put into it in addition to your stocks ISA. If you are over the age of 40, health insurance is a good idea. The NHS is creaking. If you have children, life insurance is a good idea. If you own your home insurance is key. Understand your cash flow. If you don't master your money will master you. So it's very important that you understand where your money is going, how much you have. A lot of us spend money based on our perceived impression of our wealth, what we deserve, what we should be doing at this level, what we should be doing at this age. But you are earning 30,000. You are earning 30,000, but at this level you should be driving Range Rover. Who said? Who said? Release yourself from the shackles of expectation and live within the cash flow that you have right now. I am delighted that you have hung in there for the last 2.5 hours. You have done fantastically well. I am super proud of you. I have a few more minutes for questions before we run off.
Okay.
Sorry, just a quick one. When you mentioned tax wrapper, let me just clarify. Does that mean what we're talking about, the gap of £20,000?